Hi, Professor Barati here. I want to talk to you about an important metric on the income statement that we call gross profit. The gross profit is the first important metric that you come across on an income statement, and we're going to be discussing more of this in class and showing some examples. But first, the gross profit is essentially a calculation of our sales minus our cost of goods sold. Some of you have taken cost accounting or managerial accounting. You know that the cost of goods sold is basically calculated by our direct materials, direct labor, and manufacturing overhead in a manufacturing company. Those items, those three areas of activities, basically constitute the cost of goods sold. In a retail company or merchandise company, the cost of goods sold is the cost of the items that the retailer purchased from the manufacturer. And therefore, they are already costed through inventory. And then in a service company, you would see a cost of services instead of cost of goods. So the gross profit basically represents the amount of money we earn on our sales after cost of goods sold. And essentially, it's from gross profit that we have to cover our selling and administrative costs, depreciation expense, interest, and so on. So the gross profit is the dollar we earn after the cost of our sales has been accounted for. The important metric here is not so much the dollar, but the percent, known as cost of goods ratio. Gross profit margin ratio. And that's essentially the gross profit over the sales. So 500,000 divided by the 2 million equals 25%. So 25% of our gross profit. What that basically says is that the cost of producing that sale is 75%. Therefore, a gross profit margin ratio of 25% means that for every dollar we sell, we earn 25 cents on that dollar after our cost of goods sold. That 25 cents on the dollar must now pay for the rest of our expenses, selling and admin expense, depreciation, interest, and hopefully it results in a net earnings or income. I'm presenting here Walmart. Walmart's financial income statement, which is showing us from 2012 to 2016. As you can see, Walmart has had a little growth in their gross profit, which is good. But the important thing you want to know as an analyst, financial analyst, is what percent of this gross profit is to sales. How much do we earn on each dollar of sale or revenue after the cost? So if we put this in percentage terms, you will see that Walmart's gross profit runs from about 25%. It's consistent. In some years, it's slightly under 25%. In 2016, it was up to 25%. Now, gross profit of 25% is not bad for a retailer. But stop and think, if you're earning 25 cents on every dollar of revenue for gross profit, you don't have a lot of areas to make mistakes. Your sales and general expenses are going to be just as high at 20%. That leaves you only 4% or 4 cents on every dollar you sell for operating income. If we look at another retailer, such as a popular retailer such as Bed Bath & Beyond, they tend to be a specialty retailer. And you will see, because they're a specialty retailer, they have a higher gross profit margin ratio than a Walmart. Walmart sells a lot of cheap stuff. They'll sell some high-end stuff. But essentially, they're attracting the everyday shopper. The Bed Bath & Beyond is obviously a niche retailer that is selling higher profit margin products. And therefore, you could see that their gross profit is in the 38 to 41% range. But notice how their gross profit has been declining as a percent of sales. They've actually been losing gross profit dollars on each sale over time. And this could be a problem that a financial analyst needs to track. So if you're a financial analyst and you see that in 2012, Bed Bath & Beyond earned 41 cents on every dollar of revenue after cost, and is now earning just $37.63, you have to ask yourself, where's that money going? Is there pricing pressure? Is there cost pressure? Is the cost of materials going up? And is Bed Bath & Beyond not able to add that cost onto revenue? In dollar terms, their revenue has been steadily increasing. And so has their gross profit. But when the percent of gross profit has been declining, it's a sign that their cost is growing at a faster rate than their revenue. Let's look at Amazon, which is essentially an online retailer. Again, Amazon, like Walmart, is selling a lot of items, a lot of low-end, medium-end, and high-end. But notice their gross profit margin, despite being lower than Bed Bath & Beyond, their gross profit margin has been steadily increasing. Originally from only 24.75% to 35.09%. So their gross profit has been increasing steadily. And so has their stock price. So there might be a correlation there to success. Something to think about when you're doing financial analysis. One of the answers you'll find about impact on gross profit will be in the company's income statement, balance sheet, cash flow. But you'll also find information about why gross profit is increasing and decreasing in the company's annual report. We'll look at some annual reports and read about management's discussion of analysis and financial condition, where they will very likely comment on changes in gross profit and gross profit margin, where the problems are, and what they're doing to correct it. So, financial reports, despite being very boring, do tell a lot of story. I like to think of accounting as the people who write the story, but finance are the people who get to tell the story. So financial analysts obviously have an advantage having an accounting background because they know what goes into writing the story. But to tell the story is a different set of skills. It's a different set of critical thinking. So reading financial statements by the people who prepare them is very advantageous. Let's look at a high-tech company like Microsoft. You'll see that Microsoft's financials, the gross profit, has been declining, but it's still very high, well above a lot of other companies, but declining. Again, Microsoft will tell you that the cost of producing that revenue is going up, but it's going up obviously at a faster rate than they can pass on that cost to its customers. Microsoft's great growth days are over. Microsoft used to be like Amazon, a fast-growing company with high multiples. But those days are over, and they have to grow through acquisition and so on. But in dollar terms, their revenue has been struggling a bit in these 2 years, but essentially they are growing. Let's look at Tesla, which is essentially a high-tech car company. Look at their gross profit. Hardly anything in the early years. Not just because they were selling, but it was because they just were learning their business. They were new at their business. They had different manufacturing operations. So essentially, there was a learning curve there with Tesla. But look, all of a sudden, their gross profit really starts to grow because their sales grow. But the key is, what is the percent of that gross profit? It seems to be all over the place. And again, not very high, more like a retailer. So they do have some work to do. And again, at these gross profit levels of 27 and 22% of sales, they're not generating operating income yet. Based on their stock price of $256, we could say that basically investors and financial analysts basically are saying that eventually Tesla will get this right, and that the gross profit as a percent of sales will grow well above 30% and put them into operating income. Because it's a car company, we could take a look at Ford Motor. Obviously more of a conventional mass-produced car. Ford's gross profit are very tight at 15 and 16%. Yet Ford is able to produce a positive operating income based on very tight gross profit margins. They don't earn a lot of money on each dollar of revenue after cost. Another industry we could look at is the energy industry. The energy industry has a high fixed cost and a high basically capitalization cost. But if we look at a fixed an energy company like Exxon Mobil, we will see that their gross profit basically had a little low here and is starting to climb up and is very high right now at 39%. So they're earning close to 40 cents on every dollar of revenue after cost. How well this gross profit line performs will lead to better performance in the income before taxes and the operating income. So if you have a bad gross profit margin, it's going to make it much more difficult to generate profit. So profit and trends really start on this gross profit line. And we'll be emphasizing that throughout class. So it basically is a summary of gross profit, the metric, and its relationship to sales and the overall income statement. Thank you for watching.